Breaking news tonight, Ontario's housing market is in crisis. Home prices are climbing at a record pace while affordability continues to fall, leaving many residents out in the cold this December. We'll have full analysis and reaction ahead.
Imagine getting a 10% discount on the house price and walking into a 2.25% overnight rate environment. It sounds fake, but in Brampton this December, it's the reality. By the end of this breakdown, you will understand exactly why this specific anomaly is the single greatest buying window of the decade, and trust me, it is closing fast. Quick question before we start. Comment December below if you think prices have hit rock bottom or if you think there is more room to fall. I want to see the consensus. Right now, we are witnessing a statistical unicorn in the Brampton real estate market. Historically, economics works like a teeter-totter. When interest rates skyrocket, property values usually plummet to compensate. Conversely, when money is cheap, prices surge. But December 2025 has broken the matrix. We are seeing a simultaneous downward trend in both asset cost and borrowing cost. This is the definition of a December disconnect, and it is a rare market condition that savvy investors dream about but rarely see in their lifetime. Let us look at the hard data. The average sale price in Brampton is currently hovering right around $904,752. That represents a staggering 8.4% shift downward. We are talking about nearly $100,000 in value that has just evaporated from the sticker price compared to previous peaks. This signals a major affordability shift. You are not just buying a home, you are buying into a market that has effectively put itself on clearance. And here is the conflict that makes zero sense on the surface. The Bank of Canada has slashed the overnight rate all the way down to 2.25%. Money is cheaper than it has been in years. You have massive price reductions and historically attractive financing aligning perfectly. Yet, looking at the transaction volume, buyers aren't flooding the market. Why? Why is the public hesitating when the math screams buy? That is the mystery we are unraveling today. While the rest of the GTA is softening, Brampton has hit a specific price floor that changes the math for every first-time buyer watching this channel. We need to dissect the number that has just hit the charts for the first half of December 2025. $904,752. $904,000. That is the average residential sale price across all asset classes in Brampton right now. We need to pause and really understand the gravity of that figure. For the better part of the last 3 years, the $1 million mark wasn't just a price tag, it was a psychological and financial iron curtain. Breaking below that barrier and settling firmly in the low 900s signals a fundamental shift in the market's baseline. We aren't just seeing a seasonal dip, we are seeing a structural repricing. When the average sits at $904K, it implies that a significant volume of inventory, specifically freeholds, townhomes, and semis, is trading well below that $1 million threshold. This matters because it changes the stress test requirements, it changes the down payment structures, and it changes the affordability index for the average household income in Peel region. We are flirting dangerously close to the 800s if this momentum carries into January, completely erasing the gains of the post-pandemic boom. Now, let's widen the lens because a number in a vacuum is useless without context. We have to look at the comparative analysis. Brampton is currently down 10% year over year. That is a double-digit correction. Compare that to the broader Greater Toronto area. The GTA as an aggregate is sitting at an average price of $1,039,458. That represents a decline of only 6.4%. This divergence is the most critical data point we have. Brampton is correcting nearly twice as hard as the rest of the Toronto Real Estate Board's region. We are trading at a nearly $135,000 discount compared to the GTA average. While other municipalities are seeing a soft landing, Brampton is experiencing a hard reset. This 10% drop effectively wipes out the speculative premium that was added to our market during the frenzy. If you are a buyer, this gap, This disparity between Brampton's 10% drop and the GTA's 6.4% drop is your margin of safety. It suggests that Brampton has already absorbed the pain that other regions are still trying to delay. Finally, I need you to understand the mechanics of this specific data set. We are looking at early December numbers. In the world of real estate data analysis, this is distinct from a full monthly report. Why is this critical? Because real estate in December essentially shuts down after the 15th. The back half of the month is a write-off due to the holidays. Lawyers are away, banks are slow, and nobody is listing homes. Therefore, these numbers from the first 2 weeks of December are not just a mid-month check-in. They are effectively the final verdict for the year 2025. This isn't lagging data from October, this is real-time transaction data from the last 10 days. When we see $904,752 in early December, we can confidently predict that the final year-end report will mirror this reality. This is the baseline we are carrying into 2026. We aren't guessing anymore. The market has shown its hand. The lag usually associated with sold data is minimized here because the volume drops to zero immediately after this reporting period. This is the floor. I want to throw this back to you because data is one thing, but street-level reality is another. When you are looking at listings right now, are you seeing sticker prices that reflect this new 900K reality, or are sellers still clinging to those 2024 evaluations? Are you seeing this in your area?
If you thought the detached market was immune to the 2025 correction, the November and December numbers just proved everyone wrong. We need to have a serious, unfiltered conversation about what is happening with Brampton detached homes right now. The data has settled, and the average price for a detached home in our market is currently sitting at $1,047,585. That number, 1.047, is incredibly precarious. We are hovering just inches above that psychological $1 million floor. To put this into perspective, we aren't just seeing a seasonal slowdown. We are witnessing a repricing of the most coveted asset class in the city. For years, the detached home in Brampton was the ultimate goal, the safe haven for equity. But as we close out 2025, that safety net looks distinctively frayed. When you contextualize this against the wider GTA average, Brampton has always pitched itself on value. More square footage, bigger lots, for less money than Mississauga or Vaughan. But here is the problem we are facing in December. The carrying costs on $1 million mortgage, even with the slight rate relief we have seen, are eroding that value proposition. Buyers are doing the math, and for many, the Brampton discount is simply not steep enough to justify the monthly payments anymore given the current economic climate. This is leading to significant volatility in this specific asset class. We are seeing a massive spread between what sellers think their detached home is worth based on 2023 or 2024 numbers and what the buyer pool is actually willing to sign for today. The days of holding firm on a price are gone. In November and December alone, we saw listing terminations skyrocket as sellers pulled back, realizing they missed the window. This volatility suggests that we might actually see the average detached price dip below the $1 million mark in early 2026 if inventory levels do not tighten up immediately. It is a buyer's market, strictly speaking, but it feels more like a stalemate. The move-up buyers, the people selling townhomes to buy detached, are stuck because their townhomes are not selling, paralyzing the detached market further. It is a chain reaction that is keeping that average price pinned dangerously close to the seven-figure drop-off. So I have to ask you directly, are you seeing this in your area? Are you seeing for sale signs on big detached homes sitting on the lawn for 60, 90, or even 120 days? Or are properties still moving in your specific pocket? For the first time in a long time, you don't just have a choice in Brampton, you have 25% more choices than you did exactly 1 year ago. That is the headline for December 2025.
We are witnessing a fundamental restructuring of the marketplace, an inventory explosion that has completely redefined the power dynamics between those holding the deed and those looking to acquire it. Let's do a deep dive into what is actually happening on the ground right now, because the numbers we are seeing in the last 28 days are nothing short of historic for this time of year. Let's start with the raw velocity of new product hitting the MLS. In the last 4 weeks alone, we have seen 962 new listings come to market in Brampton. Now, to the untrained eye, that's just a number, but you have to contextualize this against the calendar. We are in December. Traditionally, this is the moment the market goes into hibernation. Sellers usually pull back, waiting for the spring roses to bloom before planting a for sale sign. But not this year. Nearly 1,000 homeowners decided that right now, in the middle of winter, was the time to exit. That volume of fresh inventory entering the system this late in Q4 signals a massive shift in seller sentiment. It suggests an urgency we haven't seen in previous cycles. And for you as a buyer, it means the buffet is fully stocked when it's usually empty. But the new listings are only half the story. The more impactful metric is the accumulation of stock. Active listings are up over 25% year over year. This is the leverage shift I'm talking about. Think back to the frantic markets of the past few years. If you wanted a detached home in Brampton, you were fighting 20 other people for one scrap of inventory. Today, that scarcity mindset has been obliterated. With active inventory swelling by a quarter compared to last December, the scarcity premium has evaporated. Sellers no longer have a monopoly on the negotiation table. When inventory rises this sharply, price discovery becomes a two-way street. Sellers are realizing that if they want to move that property before 2026 rings in, they cannot dictate terms the way they used to. They are competing against their neighbors, and that competition is your greatest asset. This leads us directly to the metric that matters most for your peace of mind and your wallet: median days on market. We are currently sitting at 28 days, 4 weeks. In the era of the frantic bidding war, homes were selling in 28 hours, sometimes 28 minutes. Now, a home sits for a month on average. This specific metric, 28 days, is the holy grail for a prudent buyer because it reintroduces the concept of due diligence. When the median days on market expands like this, it signals the death of the unconditional offer. You no longer have to gamble your life savings on a home you've seen for 15 minutes with no inspection. In this environment, you can and you should include conditions. We are seeing the return of the financing condition, allowing you to fully secure your mortgage commitment with your lender without losing sleep. We are seeing the return of the home inspection, allowing you to check the roof, the furnace, and the foundation before you commit. We are seeing status certificate reviews for condos actually happening before the deal is firm. This safety net was non-existent when inventory was tight. The 28-day buffer means you can view a home, go home, sleep on it, bring your parents back for a second look, and then make a rational, calculated offer. You can negotiate on price, closing dates, and repairs. This is the power shift. You are no longer begging a seller to pick your offer. You are presenting an offer that they need to consider seriously because there isn't a lineup behind you. This creates a unique window of opportunity where you can buy a premium asset in Brampton without the premium stress. But I have to ask you, are you seeing this in your area? Are you seeing for sale signs sitting on lawns for weeks instead of days? Or are things still moving fast in your specific pocket? Let me know in the comments, because while the macro data says slow down, real estate is always hyper-local. Rates are friendly, prices are lower, so why did 13% of the buyer pool disappear from Brampton this month? This is the fundamental paradox defining our market in December 2025, and it is the single most important metric we need to unpack. We are currently staring at a scenario where the cost of borrowing has objectively improved. The mortgage rates that were absolutely strangling the market earlier in the year have finally softened. Theoretically, by every rule in the real estate playbook, this should be the green light that buyers have been desperate for. Yet, the data from the Brampton Real Estate Board contradicts every basic economic principle we rely on. We are seeing transaction volumes plummet by 13%. To put that in perspective, that is a double-digit exit of demand in a month where affordability actually got better. It completely defies the standard logic that lower rates equal higher sales. Instead, we are seeing the exact opposite: cheaper money, fewer takers. We have to contextualize this, because if you look at Brampton in isolation, you might think there is a localized crisis or a specific issue with our municipal taxes or infrastructure. But this is a symptom of a much larger region-wide freeze. When we zoom out and look at the Greater Toronto Area as a whole, sales are down 15.8%. We only saw 5,010 total sales across the entire region. For a population center of this magnitude, 5,000 sales is virtually a standstill. It is anemic volume. This indicates that the hesitation isn't about a specific neighborhood in Brampton. It is a systemic, region-wide reluctance. The entire buyer pool, from Mississauga to Scarborough and right here in Brampton, has collectively decided to step back from the table. We are witnessing a massive liquidity crunch where the buyers exist. We know they are there because they are viewing listings online and checking the portals, but they are absolutely refusing to transact. This brings us to the psychological root of the problem, and this is the most critical part for you to understand if you are thinking of selling or buying right now. Why are buyers waiting? We know prices have dropped 10%. That is a substantial discount. On an average detached home in Brampton, that represents a massive amount of equity that is no longer required to enter the market. But here is the catch. In a falling market, a discount doesn't look like an opportunity. It looks like a warning sign. Buyers are not motivated by the 10% they save today. They are paralyzed by the fear of the 5% they might save tomorrow. This is the classic psychology of catching a falling knife. When a buyer sees a 10% drop, they don't think bargain. They think, if I buy now in December and the market drops another 5% by February 2026, I have just erased my down payment. This fear of immediate negative equity is far more powerful than the allure of a slightly lower interest rate. They are waiting for the absolute bottom, a definitive signal that the bleeding has stopped. Until they see prices flatten or even inch up slightly, that 13% of the buyer pool is going to remain on the sidelines, watching, waiting, and refusing to sign on the dotted line. It creates a unique frustration where the market fundamentals say buy, but human emotion says wait. Are you seeing this in your area? Are you noticing neighbors listing their homes only to take them down 3 months later because the offers just never came?
The Bank of Canada just handed buyers a gift on October 29th, but sellers are the ones frantically trying to figure out how to unwrap it before the new year. We are currently standing in the wake of the October 29, 2025 announcement, where the central bank slashed the overnight rate down to 2.25%. Now, in the headline-driven world of real estate news, people see that number and simply think cheaper mortgages. But as sophisticated market watchers in Brampton, we need to look closer at the mechanics of what this specific rate cut does to the December qualification landscape. This isn't just about monthly payment relief for variable holders. This is about the barrier to entry being lowered at the exact moment inventory is highest. When the rate hits 2.25%, the stress test qualification rate, the hurdle every buyer must jump over, drops proportionally. For a family in Brampton looking at a detached home that was priced at $1.1 million, the income required to service that debt just decreased significantly compared to where we were in the summer. We are talking about thousands of dollars in qualifying power being unlocked overnight. This is the 2.25% solution. It solves the liquidity crunch that has been choking the move-up market all year. But the rate cut is only half of the story. The second and perhaps more critical component for 2026 planning is the predictability factor. For the last 3 years, the Brampton market has been paralyzed by volatility. Buyers were terrified of catching a falling knife, and sellers were terrified of selling at the bottom only to see rates drop the next month. The Bank of Canada's messaging alongside this cut has been explicitly clear. They are signaling a hold strategy. They are signaling that the inflationary beast is tamed and that 2.25% is the baseline for the foreseeable future. This removes the volatility premium from the market. It allows a buyer to sign a purchase agreement in December 2025 with a closing date in March 2026, knowing with a high degree of certainty what their financing costs will look like. That psychological safety net is what has been missing since 2022. Now let's layer this onto the pricing environment we discussed in previous sections. This is where the opportunity becomes almost too obvious to ignore, yet so many are missing it. We have a soft pricing environment in Brampton right now. Facts don't lie, inventory is lingering and sellers are weary. Usually when rates drop this aggressively, prices react instantly. But there is a lag. We are in that lag right now. We have the maximum affordability intersection, the lower cost of borrowing from the October cut, combined with the suppressed listing prices of a sluggish December. This window does not stay open. Once the spring market catches wind of this stability, that soft pricing will harden. So the 2.25% solution is effectively a time machine. It gives buyers the purchasing power of a low-rate environment while they are still shopping in a high-inventory, buyer-friendly market. It is a rare alignment of economic policy and market cycle. Are you seeing this in your area, or are people still paralyzed by the headlines from 6 months ago?